regulatory agency.
All right, welcome back to the program. Joining me right now is Dr. Mahmud, who is the Director of Monetary Policy Department of the Central Bank of Nigeria. Earlier on, I did mention that the central bank's MPC did meet yesterday, yesterday and Monday actually, for the July meeting. That meeting happens 6 times a year. I've said it times without number on the show, but in case you're hearing it again, it's 6 times a year. The next meeting will be in September. Dr. Mahmud, welcome to the program.
Good morning.
Good morning.
Nice to be here.
Likewise, nice to have you. What really happened yesterday at the MPC, the decisions? It seems what I can read, let me tell you what I can read, or what I've read.
Yes.
I don't know if it was deliberate from the MPC's part to have that meeting in the evening. That's the first of it in many years that at least I've been on this beat. And I was like, okay, whether it's intentional, the market would have closed, but it's for you to respond. Then secondly, the mixed signal that this MPC is given, and the mixed signal in the area of, it seems that when this administration came in, that Central Bank of Nigeria is trying to be a little bit lax in terms of taking an accommodative stance, in terms of, okay, the liberalization of FX. For example, just before I came in also, I saw that the post-note debit on Naira Bet, Abuki FX, and some other companies have been lifted by the central bank giving to their banks to inform their clients. So some kind of accommodative stance. But yesterday, 18.75% interest rate increase for a country that is strangulated right now by a 2.35% growth in the first quarter of 2023, by 22.79% inflation rate, by the cost of living crisis that we have right now, occasioned by the removal of fuel subsidy. So please just speak to me about these readings of mine.
Thank you. For the first one on the timing of the press conference, your guess is right. Yeah.
So my guess is right.
Very right, very correct. And it was the management that felt it should go that way so that we don't have some noise in the market before then. Because, you know, there are anticipation on what will CBN do, what will be the policy reactions to what is going on. So that was what informed that. And I think going forward, that will be the style. Now, on the issues you raised and what informed the monetary policy decision, there are various sides to the equation. And we always say that the primary mandate of central bank and the Monetary Policy Committee is to ensure price stability, by extension, financial system stability too. What was before the MPC members were, you know, a barrage of issues, both from the global and the domestic scene. But let's leave the global first. Let's concentrate on the domestic scene. On the domestic space, like you mentioned, inflation was 22.79. GDP also went down quarter on quarter for the first quarter of 2023. What we're looking at is the liquidity in the system. And we saw that the build-up in the liquidity was quite phenomenal over this period. 3 or 4 factors are playing out there. The liberalization of exchange rate, like you rightly mentioned, was something that is seen, you know, depreciation at the FX market now. You know, the acting governor told us not to call it INE again because it's not only for importers and exporters. Everybody can play in that space. The depreciation that was seen there is just a process for the market to discover its long-run equilibrium space. It is not unexpected. The bank is not just saying that as a shock. The bank is saying that as a process that we think will happen. And we have instruments and procedures in place to come in when it is necessary to come in. We're also monitoring the behavior of operators in that market in terms of the price discovery potentials of that market, because we said it's market-driven, but that does not mean that the central bank will just sit and the market will go anywhere it wants. We have, like the acting governor also said, we have what we're looking at as a long-run equilibrium, you know, state, and as we are overshooting or undershooting that space, central bank will play its own role. On the decision to raise the MPR by 25 basis points, And from the vote, you will see that it was quite a kind of
almost
a balance.
close,
Yes. 5 members were for hold. And the reasons for those that felt we should hold was, one, the economy is already overheated, just like the points that you raised, poverty level, unemployment level, cost of government borrowing is also going up.
But those arguments are valid.
They are valid, but hear the other people's side too.
Yes.
Those that are asked to tight. So that's why I started with that one. Then those that now wanted for tightening were also looking at, they looked at these factors that the hold people are also, the hold members were advocating. But the other critical issues that were coming up, and they were very significant, was the fact that injections are coming in from palliative, 500 billion. We don't know how the World Bank $800 million will also play out. Even from the gains, FX gain, from what will go to FAC, has also increased. So that means another pumping in of liquidity will come in. The pass-through from the exchange rate depreciation was also going to hit inflation. So a lot of injections are coming in. We're already experiencing liquidity surfeits in the system. You see the OBB rates and treasury rates in the market are all going down, right? While the MPR is way up there. So the point is, if you are seeing these injections coming in, where will you now hold? Because hold, yes, it's not losing, we are still in a tightened mode, but it will mean that you are not giving the signal to the domestic economy and the rest of the world that you have reversed your tightening mode. It's just like what happened in the United States. The United States held, but said that we are going to tighten further if things do not balance up. There the inflation number is going down already. The last one they had was 100 basis points. But, you know, the base effect played out there, but that is not still the important thing. What was critical was that inflation numbers are going down, growth is improving.
Okay, so with this, sorry to cut you short, this is just coming to me now. With this rate upward adjustment that you're doing, and yet we are not seeing inflation go down. I understand, because the reasons have been given even in previous MPC meetings that if we had not even been tightening, inflation rates would have been more than that.
Thank you.
I understand, so don't give me that, Dr. Mahmud.
Yes.
What I am actually now asking is that even with this, money supply is still up. As at June, the total money supply, I think about 64 trillion naira, if I'm not mistaken. For June alone, I think it was about 2.9 trillion naira. So if you say that you are chasing money supply, where in a country purchasing power is down, where in a country people don't even have the naira now to spend, as it were. So where is the economic sense there? Don't you think that Nigeria's inflation fighting is away now from the economics textbooks that you people have been studying, or you studied, because I know you're even a doctor, you know, so please explain.
Yeah, I will start from where you mentioned the income level and poverty and disposable income. That is why inflation is even more critical. Because even if your earning is going up and inflation is going up commensurately, you are zero. You are still on the same platform. But even if your earning is the same and inflation is going down, then your propensity to spend, they call it marginal propensity to spend, will improve, because the real disposable income will have increased. So the inflation that we're fighting is even more critical for the low income.
Now the question is that the inflation you people are fighting, what's the source of the inflation?
Yes, thank you very much. Two sides of the equation. The structural side, which you know very much about, all those other issues that are outside the purview of the central bank, and then the monetary side. And these things we're doing is we've come to the realization that, you know, central bank cannot solve the entire problems of the country. And you will see that in that communique, the acting governor was emphasizing collaboration between fiscal and monetary authorities. It is the period of where you see central bank, you know, being counter-fiscal is gone. At this era, we need to sit down together, plan the medium-term expenditure profile with the government, even though central bank gives commission to that. If government spending are coming, you know, there was also a suggestion that there should be a very close bilateral relationship between the fiscal and monetary. so that we have a proper coordination of this. And that's why I said these injections that are coming in, they are necessary injections. We cannot say because of inflation, no, government don't give palliative. No, those palliatives will come, but we'll plan how those will not become a monetary phenomenon that will drive inflationary pressure. Because if you give people money, and there's not, the things to buy did not change, which will not even change in the short run. Because if you give money today, that money will hit your account today. But the production of rice in Wuse market will not improve today.
No,
it will take time to improve. So, wait, let me finish. Yes. So that I wanted to learn, sorry.
Yes, it's okay.
So the point is, because that liquidity that will come in, those funds that will come in, that will come and meet that stable or that constant supply state will become inflationary. That's what we call demand pool. So everybody has money, goes to the market, they have only maybe 5 farmers that brought yam to the market. Everybody wants to buy. The price will be going up.
Why did the 5 people only bring yam to the market? That was the question I wanted to ask.
Okay, yes, that was because it was that day. By the second, third day, as people see that the prices are going up, they'll start rushing into the market. And that's when you see maybe the farmers are coming from Garki or Nyanya, or by the time it starts moving up, Lokoja will come in, Oshun will come in, Mina will come in. You start going to where, so the demand drives the supply that comes to that space. But what I'm emphasizing is that the production process to increase that rice is not a day. You have to plant and everything.
Yes, and the production process is not CBN's job.
It's not.
Fantastic.
So your question was the drivers of inflation.
Yes, that inflation we're seeing in Nigeria, because we've been fighting it now for about a year or so, since May 2022.
Since Central Bank
started, since
yes.
May 2022, you've had that upward adjustment of rates. So what history in the last 1 year has taught us now is that inflation in Nigeria may not be a monetary phenomenon. It could be more of structural phenomenon that the central bank has no purview.
Yes.
President Tinubu declared a state of emergency on food.
Yes.
Which I suppose that perhaps insecurity and all of that should be what they are looking at. If insecurity is attended to promptly, you might begin to see that instead of having 5 farmers now bring their products to the market, more farmers will have confidence to go back to the production, to the farm, produce more food. When you have so much supply, price definitely will drop. So, do you see, because I'm just thinking what the rationale is behind all of this in the last 1.5 years, and it's still not going down. And if it's not going down, what will now happen for the central bank's MPC? What will break the central bank's MPC to stay hold? Like we've also been seeing the Reserve Bank of South Africa just a few days ago muted its own rates.
US is doing today, so we'll see what they will do.
Yes.
Yeah. Now, we are aware of the fact that inflation, particularly the food side, are structural phenomena. They are driven by factors that are, and if you look at even the component of the inflation, food inflation is also rising. And food in the CPI basket is taking over 50%. So whatever happened in that space is important. But it's not necessarily the price of the food items itself that is rising, but the cost of bringing those food items to those that will eat them. Transportation cost is building up. The cost of using silos or storages is also building up. The security challenges in those places, so people are not able to go to the farms. Those are the structural issues we are mentioning. But if you remember, Nancy, after COVID, or during COVID, billions, trillions of naira, when Nigeria did over 7 trillion into the economy to support people that were not able to produce or do their businesses. This was a global phenomenon. And that post-COVID now made many economies to have what we call demand pool inflation. The monetary phenomenon was phenomenal at this time. The monetary component of it was, of the drivers of inflation, was big. So what was important was tighten to bring, because the tightening they were doing was actually to even reduce credit, to reduce aggregate demand, the ability of people to buy. That was what they were doing. So what that means is that because the supply is not meeting up with the demand, so prices are going up. But if you want the disposable income you mentioned to be in real terms positive, then inflation must go down significantly.
So that
to
your
get
naira can buy more.
more. The same thing happens at the FX window. So what drove this increase was the fact that those built up, and that's what we call pent-up demand, all those built up will need to be cleared. They can only be cleared not in the immediate term, but short to medium term, because like you mentioned, supply will now start picking up. That is if there are no security challenges, that is if infrastructure has improved, that is if PMS prices are not going up, so much that you also get that feeding into the cost of transportation, then those other things will have to play out such that you see the supply hitting the market and demand is going up. You see most of the economies we have, if you see smaller economies that have less population than Nigeria, you see their per capita income, GDP is like $5,000–7,000 per individual. Nigeria we are less than 2,000.
Yes.
So is the proportion of the population as against the GDP numbers we have, or the GDP in terms of income level. So addressing the monetary side of the inflation that's what is within the purview of the central bank. And the acting governor in the communique also mentioned that there are other liquidity management tools and instruments that central bank will need to deploy.
Do you still have them?
We have OMO. OMO is there.
Because why I asked that question is because it seems that some of the tools that the CBN has been deploying,
we've not been very active on OMO for a while. Now those tools will be triggered and launched. There's a need to manage, because number one, the excess liquidity in the system is one. The ability of the banks to lend to some other sectors that are challenged by this structural factor is also limited. So you want banks to go into agriculture, to go into other mining. Meanwhile, those that are doing the mining are artisanal miners. They don't have address. They don't have how you can track your funding. Don't forget the banks are also holding shareholders' funds. They are accountable to those people. So there's a limit to how much the central bank can push banks to go on. It's a private business.
Now,
and that was what prompted our interventions.
Now that you've brought me to the banks, the CRR was still kept at 2.5%. Yes. In some other climes, we've seen the CRRs of those countries lower. Yeah. The MPC has maintained the CRR now for close to, I think, the last 3 MPCs, if I'm not mistaken. The CRR at 2.5%. What it means, let me just explain to our viewers, is that for every 100,000 naira perhaps a bank has to deposit 32,500 naira with the central bank. That's what just the cash reserve ratio means. Earlier, some weeks ago, or was it 2 weeks ago or so, the CBN also lowered CRR for the merchant banks. Yes. So I was assuming that I would see a lowering of the CRR yesterday for commercial banks. Why did this happen? Why wasn't it reduced?
If we lowered CRR in the face of liquidity surfeit, that would be counterintuitive.
Okay, so
in the sense that we are leaving more money. Yes, yes. Banks are still struggling to meet the LDR, the loan deposit. Yes, they are still struggling to meet that 65%. So if you now pump in more, and the reason for that is not just because the bank's lending has declined substantially, but the numerator of that equation has increased substantially. The total qualifying capital has increased substantially. So, and the denominator may be the same or even lower. So you see the proportion of credit that the banks are supposed to give will have increased significantly in that space. But if you look at the space,
shouldn't the banks give credit even at this time?
They're given.
For an economy, shouldn't the banks have more money to give out to businesses for an economy that is struggling with a growth of 2.3%? And my next question also, with what your response would be, in that room on Monday and Tuesday, were recession fears, were they echoed? Because this is a country that is battling with 2.35%. I don't know what the Q2 GDP will look like. The Q2, that's from April to June. To June.
April,
what
May,
the MBS will bring out, that would also show the reactions of this PMS fuel subsidy and all of that, and perhaps for the rest of the year. So I don't know if recession fears, concerns actually surfaced in that room yesterday. I'm not even talking perhaps for whether for the mid-term.
One. The first part of your question, the main reason why we are having liquidity surfeit is that the volume of credit that's supposed to go out by the banks. Banks' main job is financial intermediation, creating money. Creating money means giving out loans. And if you see the banks are not able to give out those loans, those money stays. You remember there was a time that when we have this outstanding lending and standing deposit facilities, we had 0 premium on SDF. And banks were still dumping money there. There was not, we won't pay you anything. Central bank will not pay anything, but banks were still bringing money to SDF because the channels of creating those credits are limited. And banks need to also build that expertise, manpower, and also to, our own is to give moral suasion for banks to go into these areas. Our interventions that we did in terms of the real sectors were still within this because we know food, like you mentioned, is driving inflation. But if you cannot get those supplies to come in, then Central Bank will not be able to achieve its own goal. But those quasi-fiscal activities, at least we've done enough now. And private investors and others have also come into that space through the loans that the bank gave. So we expect that to build up over time, but it takes time. The second part of the question was that the concern about growth was there. On certain, the wheel for July for IMF came out yesterday.
Yes.
Yeah, they revised global output growth upwards.
I was surprised
that's a good sign.
Amid the global
Well,
inflation,
you
when
see
I was
what's
watching
going on
that
in
yesterday.
the US, industrial activities are picking up, and so we see inflation in advanced economies is tapering down significantly. Our own is going up, but still less than 50 basis points. So it's still something we need to address, and that is why I said those that voted for tightening. I also emphasize that there's the need to mop up this liquidity until new channels of credit lines are created. We're also trying to narrow the gap. One thing I also want to emphasize is that MPR is not a transaction rate. MPR is supposed to be a signaling rate. Even though we've seen some anomalies where you see, OBB rate far below the lower bound of the MPR, which is not supposed to be the case, but it's also a sign of liquidity surface within the system. So the bank needs to take out this, sterilize it within the central bank. So that what is within the system is not, more than our monetary aggregate. Our monetary policy framework is monetary targeting. We have not gone to like inflation targeting or exchange rate targeting yet. But so we're looking at the monetary base in terms of the volume of money within the economy will determine the prices of goods and services.
Okay. Final question, because we have to go, and I don't know why we have to go now, but we have to go now because I have another guest.
Yeah, that's fine.
The question is, it seems that also what the central bank's MPC is trying to do is to encourage foreign investors, like what the acting governor said yesterday, in terms of encouraging foreign investment as well as narrowing the real negative, real returns. Why only foreign investment when local investment is also being strangulated?
Narrowing.
I understand what you're doing. Let it be juicy. Oh, your rates in Nigeria are juicy. Pull out money from where we are. Let's come to Nigeria. Yeah. But those are also foreign portfolio investors, as it were, that when the situation is not comfortable, they carry it and go.
Yeah. The emphasis now is, and it's in the communique we also made, concerns around deglobalization, the phasing out of unilateralism within the global space. Economies are coming into smaller silos now and doing their thing in their own way. We don't want to call it trade restrictions or tariff barriers, but that is what the world, the United States is doing. Advanced economies are doing it. We also need to be looking inwards and seeing how because if you look at some of the shocks that are happening to Nigeria today, more than 50% of what is determining how we take our monetary and fiscal policies are exogenous, are external shocks. Russian war increased the prices of cereal. COVID-19 brought lockdown. COVID-19 did not start in Nigeria. Neither did we participate in the Russian-Ukraine war, but they have impact on our economy. The Fed is increasing rates, impact on capital flow reverse and all that. So your ability to be resilient to those shocks depends on the strength of your economy. If you are not competitive enough to withstand those shocks, then try to close your space so that those shocks don't hit you. So instead of depending extensively on importation, try to produce these things locally, because even in our inflation numbers, there's imported inflation component for some finished goods. So it is important that you look inwards, produce what you can produce, and that was what informed our 41 items policy. Produce what you can produce internally, shield yourself, build yourself to a competitive level that you can now go to the global space and start doing the competition there. So narrowing that was also to improve domestic savings mobilization, because as you narrow that space, the difference between your MPR and inflation. Well, yes, it's even more important for domestic investors than even external looks at several other things.
Because it's now
liquidity and all other things.
22.79 minus 18.75.
Yes, so about 400 or so.
Yeah, about
basis point. Yes,
okay,
which is
Dr. Mahmud, we'll continue this conversation. Let there be a part 2.
Yes,
of this, because I'm not satisfied. I've not really.
You still want more?
Yes, I'm not satisfied with
the issues are really.
Yes, the issues are many.
Yes,
so we'll do a part 2.
Yes.
Thank you very much for coming.
Thank you very much for having me.
All right, I've been speaking with Dr. Hassan Mahmud, who is the Director of Monetary Policy Department at the Central Bank of Nigeria. Let's quickly take a break to bring in my next guest, Mr. Samuel Agbeluyi, who is the President CITN. CITN is the Chartered Institute of Taxation of Nigeria. We'll be looking at tax reforms in Nigeria, especially now that the President has a presidential committee on tax, But anyway, we'll be talking about that when we come back from the break. Don't go away.
The global economy continues to gradually recover from the pandemic and Russia's invasion of Ukraine, but it is not yet out of the woods. The COVID-19 health crisis is officially over. Supply chain disruptions have returned to pre-pandemic levels. Economic activity in the first quarter of the year proved resilient, and labor markets are quite tight in many places. Energy and food prices have come down faster than expected from their war-induced peaks. And financial instability following the March banking turmoil remains contained thanks to forceful actions by the US and Swiss authorities. Under our baseline forecast, growth will slow down slightly less than projected, from 3.5% last year to 3% this year, a 0.2 percentage point upward revision for 2023. The slowdown is especially concentrated in advanced economies, where growth will fall from 2.7% last year to 1.5% this year. By contrast, growth in emerging markets and developing economies will remain stable at 4% this year and 4.1% next year. Now, this masks significant differences between countries and regions, with emerging and developing Asia growing strongly at 5.3% this year, while many commodity producers will suffer from a decline in export revenues. At the same time, global inflation is projected to decline slightly faster than projected in April, from 8.7% last year to 6.8% this year, a 0.2 percentage point downward revision. Now, stronger growth and lower inflation than expected are welcome news, suggesting the global economy is headed in the right direction. Yet growth remains low by historical standards, and while some adverse risks have moderated, the balance remains tilted to the downside, and it is too early to celebrate.